All right, gentlemen, many thanks for taking the time for our advisory board call. It's a great pleasure having Jesse Felder as a special guest here. Jesse, thanks a lot for taking the time. Jim, thanks a lot for taking the time as well. I know you're currently writing a book and you're probably in the editing stage, which is, as we know, most of the work. And I think you should write more books because in the meantime, you've been basically kind of offline, but gold price did pretty well in the last couple of weeks. So
yeah, the less involved I am, the more it goes up. So I'm going to keep my head down. I'll talk about China and not talk about gold and let it keep going up. But actually, thank you. The book's actually done, and I did the editing also. So the writing and the editing are done. It's with my, it's with the senior, it's with the editorial director of my publisher, which is Penguin Random House. So she might have a few more tweaks, but everything I did was in response to her suggestions. So hopefully she's happy. So we're getting closer to, the final page pass, and then we'll send it off to the printers. The publication date is mid-October. I don't have a specific date as of now, but we're getting close.
Great. Congrats. Of course, we will probably talk a bit about the content of the book. You can give us a little teaser, hopefully. For the people that do not know Jesse Felder, brief biography. Jesse has been managing money for over 20 years. He began his professional career at Bear Stearns and later co-founded a multi-billion-dollar hedge fund firm headquartered in Santa Monica. Since moving to Bend, Oregon in 2000 and founding the Felder Report, shortly thereafter, his writing and research has been featured in major publications and websites like the Wall Street Journal, Barron's, Yahoo Finance, Business Insider, Real Vision, Investing.com, and much more. Jesse also hosts and produces the Super Investors and the Art of Worldly Wisdom podcast. Jesse, many thanks for taking the time. I think we've got many mutual friends like Grant Williams, like Raoul. I think there's the overlap of our friends is pretty big, and yeah, I'm really glad that you're joining us. I would like with very brief housekeeping. What happened on our side in the last couple of weeks? Actually, we had the last advisory board call with our special guest, Rick Rule. That was on the 8th of April. So basically in the midst of the whole COVID turmoil. Yeah, we've been pretty vocal regarding gold and of course the mining space, which has done tremendously well. Actually, it seems that gold is really in a stealth bull market. We're now trading above 1800. I think we will hit new all-time highs in US dollar terms very soon. It's trading so strong. There's so much momentum. And of course, we're going to talk about gold. And as you know, we just published on 28th of May our 14th annual In Gold We Trust report. So this has been, quite a read again. We wrote 350 pages in German and in English again. About all sorts of aspects of the gold market. We got tremendous feedback from all over the globe and already hit at almost 2 million readers. So it's really a big success, and we want to thank the whole team and of course also our partners for supporting us. Now Mark is currently with his family in Spain. I am here in Vienna. Jesse is in Oregon. Jim, you are in?
I'm in the mountains of New England.
Looks beautiful.
Yeah, thank you.
So yeah, I think let's jump into the discussion. Jesse, I wanted to ask you, I don't know your exact age, but what I'm guessing, I would say when you left the hedge fund industry 20 years ago to set up your own information business in Oregon. How do you come up with that decision, being, young, basically having a dream job like hedge fund manager back then? What triggered that decision to go out of the fund management business and just basically start writing? I think Grant once said that you're some sort of a distillery, because you're reading like many hours every day, and then you distill all those thoughts into your Felder report. So it would be terrific to hear what led you to this decision, getting out of the hedge fund space.
Right. It's actually pretty simple. I left Bear Stearns in '97 with my mentor in the business, really, and we co-founded the hedge fund at that time. We started a long only fund, a long short fund, and a short only fund, and we were also running separate accounts. We started our own broker dealer. So I was the head trader and co-portfolio manager of the funds at the time. And this was leading into the kind of peak of the dot-com mania into 1999. And so you can imagine how our short-only fund did through that period. It's a very difficult time. But our other funds actually did really well. But the reason I left the industry was, even though we were doing very well in terms of performance and in terms of raising money, we started with 100 million. And the firm, before the firm folded in 2010 or 11, I think it was up to $12-13 billion under management. I quit in 2000 because just basically with I guess moral disagreements with my partner, and he was of the mindset he wanted to do everything possible within the law to maximize returns, and then even push the envelope a little bit. And I said, I'm not interested in pushing any legal envelopes, and I could see kind of where it was headed. And so I quit the firm literally in March of 2000, right as the NASDAQ was putting in its peak. And I think it was probably a combination of those kind of moral disagreements, and then also I was buying really cheap stocks in 2000. Washington Mutual was trading 5 times earnings. Abercrombie & Fitch was a retailer that had huge returns on capital, trading 8 times earnings. And these stocks ended up doing really well in 2000, 2001, 2002 after the dot-com bubble burst. But I think it was a combination of the stress of trying to be a value investor in the midst of a mania. And I felt compelled to stick to our mandate, which is we raised money as a value shop, and we were going to buy cheap stocks and try and short things we thought were overvalued, but also had a catalyst, on the short side. And we kind of abandoned that discipline, in 1999. And so the growing, I guess, disagreement between my partner and I just led me to leave the firm. So it was not so much anything about the industry so much. It's just a decision that I felt I had to make personally.
Great. And could you let us know a bit more about the Felder report? I received this Saturday summary, which is terrific. Great links to articles, fantastic charts and tweets. But what is the focus of the Felder report?
Right. So, I mean, really, basically, I'm trying to take. I think I started as a pure value investor, and so it's still kind of grounded in that. And a lot of what we did back in the fund, I still do today, which is I follow insider buying and selling very closely. I was tweeting in February how I was seeing insider selling across a broad spectrum of companies like I've never seen before. And it was clear that a lot of these executives saw, what was coming in terms of the pandemic and thought, I might not have a chance to sell at these prices again. Conversely, when you see compelling predictive insider buying, that's one of the best indicators, that I could look at for individual stock selection. So it's grounded in that, but I think about, I guess in the mid 2000s, in the lead up to the housing bubble, and actually even through my experience going through the dot-com bust, I realized that a focus on macro was going to be very important, with central banks becoming so activist in terms of in the markets and the economy. And so that, it was about 15 years ago, I really started paying a lot more attention to macro and paying attention to narratives and trends and things that are driving prices. And so that's probably the main focus of the report now, is paying attention to what are these narratives and trends that are driving markets, and what stage of their life cycle are these narratives in. And by the way, that Saturday morning email is free. You can sign up for on my website. And I regularly feature charts from the In Gold We Trust report, because it's fantastic. I'm a big fan.
Thank you very much, Jesse. Great. Mark, I'd say let us just jump into the macro discussion. Where shall we start?
Yes.
I mean, quite a lot going on. Do you want to start off, Mark?
Happy to do so. Okay. Well, the last time we talked, as you mentioned, was early April, and what we saw on the markets was a huge roller coaster. Obviously, the up slope stimulated by a huge amount of money, which is really incomprehensible, actually, what the central banks created, and then also the measures which they've been taking. They've been pushing the mandate more and more. I think this is going on internationally, and so we saw that at the Fed, but we also saw it in Europe and other central banks. But it is what it is, and we're seeing new all-time highs even in equity markets, which is remarkable, I think, as we have a huge economic contraction. Everybody knows this, everybody is talking about it, but it seems as if everybody would be more or less fine with it. On the other side, what we are also seeing is obviously a gold price, which is doing very well. So I think what we always are stressing is have a look at equity markets priced in gold. If you look at that picture, the picture looks a little bit differently. So the rally was not really extremely convincing, if you ask me, priced in gold equity rally. Spreads closed and came back in. Corporate spreads, I mean, that was a really bad situation going into April, and I think that the central banks basically were pushed to do all these actions because companies weren't able to refinance. So that's why actually the Fed actually started buying bonds, which I think is quite an unprecedented move. So we are here now, and this everything bubble, as we've mutually all been calling this stock market and bond market bubble, is back where it was actually, and one could argue it's even bigger than it was. So on the precious metal side, we're feeling very convinced that this is going to help continue helping the precious metals. But let's talk a little bit about the other markets. I'd say what do you think? And let's start with our special guest, Jesse, perhaps. How do you perceive markets, and especially perhaps also corporate bonds markets? I think are very interesting. How long can basically this money printing going on? This is obviously a very central question for us, with only leading to asset price inflation and not leading to significant consumer price inflation.
Well, that's a great question. I really do think that the Fed is starting to run into some, or they will start to run into a couple of impediments to the unprecedented policies that they've been putting in place. I think one, they can only continue to print as much money as they have as long as the currency markets will tolerate it. I think at some point, my friend Bill Fleckenstein has been writing for years that at some point, the bond market's going to take the printing press away from the Fed, and I think it's probably more likely that the currency market will take the printing press away. That at some point, if they decide we're going to have to monetize all of this new debt creation that the federal government is being forced into doing in order to try and support the economy and try and support the markets at the same time, it's going to, you know, I guess that the relief valve is the currency, and the dollar is going to depreciate rapidly. I think we could actually even have a currency crisis at some point. But the other potential impediment that I'm seeing is this: so many people are realizing the Fed's role in the wealth inequality that we're seeing in the country, and I think people are starting to, you know, talk about this a lot more. That you know, you cannot target a wealth effect without exacerbating wealth inequality. It's just absolutely you know, asinine to even, you know, imply that. And so when you know, Jay Powell says we have no effect on wealth inequality, you hear it from everyone. We absolutely do not believe that. And when you see it at the last couple of press conferences, he's been asked the question over and over again. So I think it's, at some point, we're already seeing you know, political ramifications of these kind of trickle down policies for so long, and that I think, you know, it's going to become even more of a political problem going forward. So I don't know if it's going to be politics or it's going to be the currency that puts it, you know, that essentially takes the printing press away from the Fed, but I think it's going to be taken away one way or the other.
Oh, that's a very interesting point. Jim, you want to jump in? I'm sure you have a lot of interesting thoughts there.
Yeah, sure. I think Jesse made a number of very good points. I would just to kind of expand on that, maybe offer a slightly different take on it. The money printing has almost nothing to do with inflation. That's sort of an Austrian Milton Friedman construct that for which there's almost no empirical support. It's just not true. So I think the Fed can print money all day long. They have printed money for 11 years, 12 years actually, and we're not seeing the inflation, and we won't based on that alone. The greater danger right now is deflation, starting with disinflation, going into deflation. As far as the everything bubble is concerned, I agree that there's an everything bubble. When you look at the stock market, that's just the Fed pumping it up. So I completely agree with that. I don't believe that government bond markets are a bubble. I think they have interest rates have a lot further to fall because interest rates are, you know, not far from all-time highs at the moment. Of course, I'm talking about real rates, not nominal rates are irrelevant. That's what you hear about on TV. You have to think in terms of real rates. And if I'm right about this inflation and deflation, real rates are going up very steeply because they're not cutting. Nominal rates is zero, but if you get more disinflation, more deflation, the real rate is actually going up, which is the worst thing you want in an economic depression. And that's another point I would make. The National Bureau of Economic Research on a couple of weeks ago said they announced we're in a recession, which is their job. And they said the recession started last February. Usually they wait 2 quarters. They wait until there's 2 quarters of declining GDP with rising unemployment, a couple other bells and whistles, and then they wait a couple months, and then they have a meeting, and then they say we're in a recession as of like last year. So that's an announcement I fully expected, but I didn't expect it until maybe, you know, late this year, early next year. Well, they jumped the gun. They said we know things are bad enough that we're declaring a recession. It's you know, probably not doing President Trump any favors with the Harvard MIT crowd, but I agree with that. We're certainly in a recession, but that is irrelevant. What's much more relevant is that we're in a depression. We're probably actually out of the recession already. If we went into a recession in February, we're seeing, you know, unemployment's declining, still quite high. Growth is expanding, not enough to dig us out of the hole. And you hear a lot of happy talk from, you know, the White House and Washington, D.C. and CNBC. They're like, hey, you know, we created what I think was like 4.8 million jobs in June, which is true. Unemployment dropped from 13% to 13.3% to 11%, which is true. A lot of the PMIs are coming out north of 50, which indicates an expansion, which is true. So they're like, happy days are here again. And you have to take a deep breath and say, no. When you go down 35% at an annualized rate, which comes out to, you know, 7 or 8%, maybe as much as 10%, in absolute terms. And so just if you have a nominal 100, if that's your $22 trillion GDP, but you just give it a value of nominal 100, and you go down to 90, and you grow at 5%, which we haven't done since 1982, by the way, you're still only back to 94.5. And if you grow at 4% the year after that, you're still only back to about 98, 99. In other words, we're not going to recover. We're not going to get to 2019 output levels until 2023 at the earliest. We're not going to get to 2019 employment levels until 2025. That's a depression. When you have to take 3, 4, 5 years to get back to prior levels of employment and output, that's a depression. And people don't understand what depressions are. They, first of all, academic economists have banished the word. They don't use the D word. They don't use it because it's difficult to quantify, and you can't plug it into a closed form equation, so therefore it doesn't exist. But in the real world, they do exist. And the difference is if a recession is 2 quarters of consecutive declining GDP, which we might not even get, by the way. We might have growth in the third quarter, but be that as it may. Well, sorry, I guess the first quarter was down. So, yeah, so you get your 2 quarters. So people say, well, gee, a depression sounds worse than a recession. So if a recession is 2 quarters, a depression must be 6 or 7 or 8 or 10 quarters. It must be really bad. That's not what a depression is. You can have, for example, during the Great Depression, which is generally data from 1929 to 1940, we had 2 technical recessions, 1929 to 1933 and 1937, 1938. But 1933 to 1937 was one of the strongest growth periods. Stock market rallied, unemployment went down, growth was substantial. We had a significant rally in the middle of the Great Depression, but the point is, we were so low, the levels were so low that even with the rally, if you saw unemployment go from 25% to 14%, that's nice, that's good, but it's still 14%. I mean, that's the point. And so depressions are not defined as continuous decline in GDP. They're defined as a prolonged period of below trend GDP with no potential to rally and regain the prior output level. That's a depression. And so when if you take all the recoveries since 1980, and that's a very prosperous period. I mean, actually recoveries in the 50s and 60s were stronger. But if you just take the period since 1980, growth in the average recovery was 3.2% annualized. But if you take the recovery beginning in June 2009 for 11 years, 10 and a half years, that growth was 2.2%. So I rate that as a recession. If your long-term trend is 3.2 and your actual is 2.2, that below trend growth is what a depression is. We've left $4 or $5 trillion of wealth potential on the table. $4 or $5 trillion that's not there because we could not get back to trend. Well, the same thing's going to happen now. We'll have growth, as I said. We'll probably have growth in the third quarter, but if the new trend is something like 1.7, 1.8%, which is what I expect, not only is that nowhere near the 5% I was talking about in the hypothetical, I was being generous, but it's not even as good as the 2.2% we saw in the 2009-2019 recovery, which was the worst recovery in U.S. history. So the big problem is we're in a depression, not defined as continuous declining growth, but as defined as a prolonged below trend growth. We never make up the wealth gap. We never recover the lost wealth. And meanwhile, what's going up faster than ever, which is, and that's the debt. So what's happening to your debt to GDP ratio, where debt's going up this year, maybe, well, this year is going to be 20% of GDP. But even if that kind of gets back to a $1 to $2 trillion deficit in 2021, it's still going up by 10% of GDP. Mm-hmm. So if the debt's going up, 10% or more, but your growth is going up 1.5 to 2%, which is what I expect. What's happening to your debt to GDP level? You start to look like Lebanon or Greece or, heaven forbid, Japan. And the point being, and Japan's been in a depression since 1990. So, and then there's very good research that shows that, and this is something that monetarists and neo-Keynesians simply don't comprehend, but the empirical research says that at debt to GDP levels north of 90%, and we, at the beginning of the pandemic, we were 106. We're going to end up at 120, 125. We're catching up to Italy pretty quickly. At those levels of debt to GDP, there are behavioral changes. And once again, the academic economists don't know how to account for behavior except just look around, right? Behavioral changes that people save more, they spend less, they begin precautionary savings programs because they don't know how it's going to end. They're like, well, it's either going to be hyperinflation or default or restructuring or just going to get worse in terms of deflation. They don't know how it's going to end. They just know it's going to end in such a way that it's either going to be higher taxes or taxation in the form of inflation. And so they begin precautionary savings to prepare for that day. Again, something the economists don't know how to account for. I mean, the savings rate in May was 33%, not 5%, 4%. It was 33%. Even if it levels off at 20, you're starting to look like these are starting to look like Japanese and Chinese savings rates. So, and savings can be a good thing if you can direct it to productive investment, but we haven't shown much ability to do that. And meanwhile, savings comes at the expense of consumption. 70% of US GDP is consumption. If you convert consumption into savings, where's your GDP? Plus velocity declines. I always remind people that $5 trillion times zero is zero. And this is what gets back to the money supply. Print all the money you want, but if velocity is declining, you're not going to get inflation. You're not even going to get nominal growth, let alone real growth. So just to sum up, I would say we're in a depression. It's going to persist. It's going to be intergenerational. It'll affect our children behaviorally. There's only one way out of it, but central bankers have forgotten what it is.
Jim, great points. I just wanted to refer to a great study coming out from the San Francisco Fed. It's called Longer Run Economic Consequences of Pandemics, where they basically analyze 15 pandemics dating back to the 14th century. And as you rightly say, that the major finding is that they're seeing a secular shift to greater precautionary savings. And at the same time, investment demands tend to decline. So I don't know, perhaps this is also a reason why we cannot completely rule out negative rates in the US. And what the study says, following a pandemic, the natural rate of interest declines for decades thereafter, reaching its nadir about 20 years later. I think this is a pretty good advertisement for gold, actually. But I wanted to go back to the inflation discussion. We talked about inflation already at our last advisory board call with Rick Rule. And it's interesting that Mark and I, we're really getting lots of emails and phone calls from people that are now being a bit more concerned about inflation, it seems. And Dave Rosenberg, he just wrote, talking about stagflation right now. It's as if I'm talking about dessert and we're just serving the appetizers. But I always believe in staying ahead of the curve. And I think that's a fairly good analogy that he makes. So inflation is probably not around the corner, but it's building up on the horizon. And this is really something that, as I've said, many institutional players and really sophisticated investors seem to prepare for. We're seeing it, of course, in gold. We're seeing it in the whole commodity space. Have a look at agricultural commodities, but also base metals. They're doing really well. And I just wanted to ask you, this is really something fascinating that I just read from Russell Napier. I think he's one of the greatest minds out there. I really read everything that he writes. He's hard to understand with his Scottish accent, but he's a fabulous bloke, and he was writing about basically that the control of the money supply has been passed from central bankers to governments. And I think the main point that he's making is that we're now seeing so many programs where governments basically guarantee the loans. And, you know, if I'm a banker, and there was an article in the FT where they asked senior loan officers, and 50% of them said, those loans they are rubbish. Yeah, we wouldn't do them. We wouldn't hand them out if there wasn't a state guarantee. And I think that's pretty interesting. Just recently, the Spanish government's bank credit guarantee program has been extended from 100 billion to 150 billion. So, do you think this is really a trend? Much more interference, much more control from governments regarding credit creation, because then you can finance, of course, you can make a guarantee for a new Green Deal, you can do like a big infrastructure program and so on. But for me, it might be one of the better explanations why now already the broad monetary aggregates are rising. And if we compare that to 2008, 2009, it was basically just base money that was surging, while commercial banks were fairly reluctant, and so the Federal Reserve basically just compensated what didn't happen in the commercial banking sphere. So, what do you think about that thought?
Well, I'll be really brief because I want to hear from Jesse, but I'll give you a 30-second answer, Ronnie. The first point is, by the way, you just gave an extended, very insightful summary of modern monetary theory. So everything, I'm not saying you agree with it. I'm not tagging you with it. I'm just saying everything you said is modern monetary theory. So we can talk about that. But as far as Rosie's concerned, you know, I know I'm a smart guy, of course. You will never understand monetary economics, and you will never understand inflation unless you begin by saying that Milton Friedman was wrong. As long as you cling to Friedmanism and his version of the quantity theory of money, there's nothing wrong with the quantity theory of money. It's an identity, and it's good for thought experiments. But Friedman believed that velocity was constant. And if that's true, if there's a cap on real growth of around 3.5%, and any growth in excess of that is inflationary, and velocity is constant, and you don't want inflation, then all you have to do is dial the money supply up or down about 3.5%. You'll get full growth and no inflation. And Friedman said, we don't need a central bank, we just need a computer. And that's everything I just said, which is a kind of capsule summary of Friedman, is true if velocity is constant, and Friedman believed it was. And in fairness to him, for 30 years, from 1950 to 1980, which was the main part of his career, it was constant. But it's not constant. Just go look at velocity charts that go back to the Great Depression. Look at velocity since 1998, which is when it peaked. It's plunging. Well, the minute you say that velocity is not constant, the minute you say velocity can plunge, then all the money creation in the world is simply an offset to declining velocity, and you get no real growth, which is another way of saying that money supply has nothing to do with inflation. So you've got to tackle the V variable. You've got to tackle velocity, and you've got to understand that that is psychological. That is not something you do with a printing press. That is not something you do by open market operations. You've got to change the way people think. You got to change what they believe and the way they behave, and that's very difficult to do.
But Jim, I totally agree. But I think, and you know, velocity it seems to building a base. It seems, but don't you think that point when really confidence is coming back to markets, and when everybody's getting a bit more upbeat, and perhaps there's like a vaccine against COVID, and everything is kind of stabilizing, don't you think that velocity will start rising, and this will be the point in time when central bankers actually would have to become more hawkish and
no, Ronnie, I understand there are serious travel restrictions, and I'd love to go to Switzerland because it's a beautiful country, and maybe you can't come to the United States, but come to the United States. People are the number, in a very reliable poll that's been going on for decades, the number of people who think the U.S. is on the right track is 25%. It's one of the lowest readings they've ever had. Go into the neighborhoods, go into the city. There are mass migrations out of U.S. cities. I'm talking millions of people. They're leaving New York as fast as they can. You cannot get trailers. You cannot hire movers. There are half-empty buildings, relatively new ones. They're leaving Seattle. They're leaving Atlanta, Chicago, Philadelphia, New York, Boston. They're heading for either suburban areas that seem safe, or just heading up the country. They're heading. I don't want anyone coming up here, but they're starting to. People around. I'm up in the mountains. I'm in the middle of nowhere. People are buying houses sight unseen. They're calling brokers. Broker describes the house. They look at some pictures. They go, "You're done," and they move in. That's what's going on. Most of this whole nonsense about reopening, it's nonsense. It doesn't take into account the number of people who are never reopening. They're done. It's not that, oh, gee, the doors are closed and they're going to reopen. No, the doors are closed permanently. They walked away from the lease. The equipment's up for fire sale. The employees are permanently unemployed. That's what's going on. They're lined up at the bankruptcy court. I mean, Brooks Brothers filed for bankruptcy this morning. J. Crew, Gold's Gym, Neiman Marcus, Hertz, Frontier Communications, and I don't want to mention any prospective names because I don't want to start a panic, but there's a long line behind them. And they'll be coming through, in the near term. So big businesses lining up at the bankruptcy court, small businesses shutting its doors. These jobs are not coming back. Confidence is ruined. So any notion that, gee, this is an environment to go, have a party and, spend money. The only sector that's doing well, existing housing is doing well because people are moving out of the cities. It's bad for the cities, but if you're a broker in a nice suburban area, okay. Best Buy is doing well because everyone's staying home, so they want a new TV set or CD player, or it's not a CD player, a Blu-ray or whatever music system you have, televisions, etc. So there are little pockets of prosperity here and there, but not many. This is a really, really, again, I'll go back to depressed with the point being, depression is a psychological phenomenon. It's almost synonymous, like a mental health depression and economic depression are almost the same thing. It's in my new book, by the way. And by the way, that paper you mentioned, I did read it. It's a centerpiece of my book. I was saying it's going to be 5 years, and I read this paper. It's like, 30 years. Okay. I guess we got our work cut out for us.
Jesse, do we want to jump in?
Sure. Yeah. No, I really appreciate that Jim, is emphasizing the psychological component of a depression and inflation, because I think these are things that are very difficult to model, and they are driven by psychology. A depression is really a change in consumer psychology where people decide, conspicuous consumption is no longer something that I want to do because it'll make me look bad, and people change their habits, and that's really, what drove the Great Depression. And it's fascinating to study, and I think we're seeing some of those similar types of dynamics going on right now, where people are consciously deciding to spend less, even if we do reopen the economy. But inflation works, by the same dynamic too, that people have to, and the Fed understands this, that they feel like they have to change inflation expectations in order to change inflation itself. And so I think they do understand that. But in terms of inflation, and I've been writing about the return of inflation for a couple of years now, way early, and I do think it has been even pushed back further, because if you look at just the correlation between GDP and core CPI, they're very highly correlated. So we're seeing a huge drop in GDP right now, which is why we're seeing core CPI is probably going to continue to decline for a time. But I think there are there's secular dynamic. I think, to me, that one of the biggest drivers of disinflation over the past 30+ years was a combination of demographics and globalization. So you had the baby boomers coming into the workforce. That's a huge supply of labor. And then the trend towards offshoring, which is another huge supply of labor, which pushed down, labor costs and inflationary dynamics to a great degree. But I think that trend towards globalization peaked over maybe 10 years ago plus, and we've seen a trend towards deglobalization, and I think we're going to see, with the pandemic, only accelerating this kind of reshoring of labor idea. So that's kind of a structural or secular force that I think is net inflationary, at least puts an end to the disinflationary forces we've seen for a long period of time. But I think there's also some cyclical or situational things going on right now. I think it's really important to differentiate the QE from the past to the QE we're seeing today. The QE that was created in the midst of the financial crisis, and we saw extended for years and years afterwards, was explicitly to try and create a wealth effect. We want to buy up risk-free assets to push investors into corporate bonds and other risk assets to try and push up the prices of those things, make people feel wealthier, and that will support their spending and the economy. I think the QE that we've seen really since last fall, when we had the kind of mini crisis in repo, is a different type of QE. This is QE that's not intended to try and prop up financial markets. This is a QE that's in direct response to financing government debt. And I think that's a huge difference. I think really the repo crisis was a result of massive treasury bill issuance that there just wasn't the money out there to buy these bills. And so we had kind of a squeeze in the funding markets, and the Fed had to come in and say, okay, we're going to start buying government debt again because there just aren't enough buyers out there. And to me, that is a totally different form of QE. And this gets back to my idea about the currency. If people start realizing that what we're seeing right now is MMT, that was MMT started last fall. And we're seeing MMT now, where the Fed is being forced to buy government debt because there just aren't enough natural buyers. To me, that can play into people's psychology, where they realize, okay, this is no longer something the Fed is doing on a discretionary purpose to try and support markets. They're doing it because they have to fund the government. And if people start realizing that and coming around to that mindset, that is what is going to play into or is going to result in a drop in the currency. And the combination of those things, that mindset of, wait a second, we're now in a situation of fiscal dominance, and every time the government wants to try and do something to support the economy, the Fed is going to have to print the money to do it. The Fed can't choose not to do that. That's a situation where people are going to start being concerned about the currency. And
Jesse, when you say a drop in the currency, it's like that old Montreux jazz song. Compared to what? I mean, everyone says the dollar has to go down. The dollar's going to go down. Well, if you look at DXY, if you look at the Bloomberg Dollar Index, if you look at the Fed's broad real trade-adjusted index, trade-weighted index, sorry, it's all versus the euro, not exclusively, but very heavily weighted to the euro. So when you talk about the dollar going down under any currency index, you're talking about the euro going up. You really think the euro is going to let the euro go up? It's going to kill their exports, import deflation, extend their depression. There's no free lunch. I think it's irrelevant, by the way. I think that the dollar could go down against the euro, and then the dollar could, currencies don't go to zero the way stocks and bonds do. They trade in a range. So in other words, you can't talk about a weak dollar unless you're willing to admit a strong euro, and a strong euro kills Europe. So is that the policy or the expectation?
That is my expectation. I think the dollar could fall 30–40% against euro and yen against the basket. You look back at to me, the greatest predictor of the dollar, the fundamentals of the dollar to me are the federal deficit. You look at the correlation between the dollar and the deficit. It's very, very close. The dollar was very strong during the dot-com mania and into the early 2000s. That was the last time we had a fiscal surplus. We had a deficit, as a result of the dot-com bust. Dollar started rolling over and didn't bottom until, was it 2009, 10-ish, something like that.
It bottomed in August 2011.
2011. And
that was the all-time
why was
low.
that? That was right when the deficit bottomed out and started narrowing again. So now we started this, the deficit started expanding after Trump was elected and created $1 trillion deficit during an economic expansion. First time we've seen anything like that since the Vietnam War in the late 60s. And that was why, to me, the dollar peaked in late 15 or early 16 and rolled over pretty hard, as that was the currency markets realizing, okay, wait a second, the deficit's going to start blowing out again, and now it's blowing out. I mean, so that's the difference between us and Europe too, is we're going to have massive deficits and literally no impetus at all to try and rein them in. Whereas in the European Union, you have regulations against these types of things, and still have a mindset against deficits. And you also have a central bank that is not completely beholden to try and propping up financial markets, right? Our Federal Reserve has decided not only do we need to print money to fund the government, we also need to print more to prop up markets. So I do think the Fed is going much larger. And then you also take in the other fundamental I look at is the dollar is overvalued on a purchasing power basis, Big Mac index, whatever you want to look at, 30% against almost every other.
How many Big Macs do we export every year? The Big Mac index is one of those economist jokes. I mean, it's sort of laughable.
Purchasing power, on a purchasing power basis, we're 30% overvalued against the euro.
Purchasing power is irrelevant if you can't export haircuts and Big Macs. That's the point.
Okay. Well, to me, if I look at the history of purchasing power parity across currencies, there are times when currencies are overvalued, times when they're undervalued, and those always revert over time through.
Purchasing power parity has some predictive analytic ability and a regime of fixed exchange rates. It meant something under Bretton Woods. It hasn't meant anything in decades.
Well, so do you think, so let me ask you this. Do you think that European central banks and the Bank of Japan have the ability to be as easy as the Fed?
Yeah, they proved it many times, but I also think that
they don't have as far to go with interest rates, and they can't monetize debt in the way that the Fed is being tasked to do.
Well, they can do something else. See, the European Central Bank doesn't care about European capital markets because they're not an important part of the financial system. Europe is run by banks. They care about Deutsche Bank. They care about Unicredit. They care about Barclays. Well, they're not in the Eurozone, but they care about the big European banks.
If they cared about them, they wouldn't have negative interest rates right now because that's what's killing the banks.
Well, they'll bail them out whenever it's necessary. That's my point. The same way the Fed will bail out, and they're doing it with currency swaps in the Fed. So because they need dollars, because Deutsche Bank's got a ton of dollar liabilities. So the Fed and the ECB are going to coordinate the currency. Markets are practically irrelevant, and you're not going. Yeah, they could fluctuate in a small band, of course, but you're not going to get a much weaker dollar because that implies a much stronger euro. It's just two sides of a seesaw, one's up and one's down. And you get a stronger euro, you're going to kill Airbus, Volkswagen, and we actually need them as a trading partner. It's like the reverse of the Marshall Plan.
I think, sorry, Mark. Yeah.
I was just going to say the only time the U.S. insists on a weaker dollar, and we do, and Jesse's right, we do have a weaker dollar sometimes, but the only time the U.S. allows it to happen is when our growth is so weak that you have to bail out the United States. But otherwise, if everyone else is suffering and the U.S. is suffering, but we look a little bit stronger, we'll suck it up and have the stronger currency to throw them a lifeline. That's what we're doing right now.
I think my point is that the Fed will be forced to either decide to protect the currency or to fund the government. It's going to be one or the other. They cannot do both. They cannot fund massive deficits by printing money and protect the currency at the same time. So it's a choice, I think, between the devil and the deep blue sea, right? You either print money to fund the government and allow for potential drop in the currency that could create runaway inflation, or you say we're not going to allow the currency to depreciate, and so we're going to have to rein in money printing. We're not going to be able to finance all of these deficits ourselves, and then you have to allow for a crash in the financial markets.
Well, so sorry, go ahead.
I think that's the decision that they'll be faced with.
Yeah, I agree that the Fed will print all the money it needs as long as it needs to prop up U.S. Financial markets and the U.S. stock market in particular. I agree with that.
Do you believe they can do that and prop up the currency at the same time?
That the Fed does not drive cross exchange rates. Cross exchange rates, they're not driven by Big Macs, haircuts, or the Fed. They're driven by capital flows. And the question,
these capital flows will get to the point where they're saying, I'm not going to earn 50 basis points on a 10-year T-note while you're debasing my currency by 20% per year. But that's what those foreign currency flows will do.
But how are they debasing it? The currency flows buying the dollar, making the dollar stronger. How is the money printing debasing it?
I mean, look at how fast M2 is growing right now.
Yeah, I know, but I'm saying it's irrelevant. That's my point. As long as people want to, what are you going to do? Buy TikTok, go into Chinese capital markets, invest in Hong Kong. You want to go into India? They're on the verge of war. I mean, what do you like? Turkey? They're $1 trillion worth of debt. I mean, what do you like better than dollars?
At some point, almost anything could look better than dollars.
Okay, I'll give you an answer, Jesse, and this will actually prove your point. the inflation is already here and the dollar has already collapsed, but no one knows where to look. And you look at gold. In other words, you have to stop thinking about gold as a commodity and start thinking of it as a form of money. The cross exchange rate between dollar and gold, the dollar has already collapsed and the inflation is already here, but it's in gold. And gold is the best and longest horizon leading indicator of just about everything. It's people say, oh, stock markets look forward and discount to the present value. That's fundamental analysis. I get it, but stock markets usually get it wrong. That's what they do, but they usually get the forecast wrong. If you get the forecast wrong, you're going to get the discounting wrong. Stock market did not see the 2008 crash, did not see the 2020 crash. They're not going to see the next crash. They try. I'll give them credit. They try, but they do a really, really lousy job. But the one cross rate that does a really good job, in fact, it looks so far ahead that people don't even pay attention to what it's saying, is gold. So your inflation and your collapse have already happened, but they've happened in the gold space. That's your metric.
I agree with all of that. I think the only thing that I disagree with is I don't think the Fed can monetize the debt indefinitely or infinitely without it affecting the currency.
Well, I'll agree with infinitely, but it could be a long time between here and there.
Just a few things about gold. As we tend to share a little affinity for gold, it seems. I just crunched the numbers, and gold advanced now for 7 consecutive quarters. It's trading very close to its US dollar all-time highs. If you have a look at the performance in different currencies, gold was up 18.9% last year in dollar terms, and this year, only after the first half of the year, it is up 18.1%. In euro terms, it was up 22.7% last year, and it is up 17.3% this year. And on average, gold is up 17% since the beginning of the year. So it's rising really in every currency. That's obvious, but it's also rising against the stock market, and it's rising against the bond markets. Gold, I think another sign that it's really a stealth bull market is that miners are doing really well. We are seeing huge volumes being traded in the large caps like Barrick, like Newmont, like Franco, for example, really, really large volumes. So it seems that generalists are coming into the market again. ETF inflows, significant last quarter. So it seems that gold is a bit going mainstream again, and of course we've all been waiting for it, and I don't know if you share this thought, but I think that a good investment at the beginning, it kind of has to hurt, and it has to leave you in discomfort, because if it's so obvious, then it's probably obvious to everybody. And now it seems sometimes to me that it all sounds a bit too easy. So did we miss anything? But I don't see any big U-turn when it comes to monetary policy. I see inflation on the horizon. I see that large institutional players are coming into the market. I see that Commitment of Traders report is still looking good. Silver is now kind of confirming gold, but do you sometimes wake up at night and think, geez, I did forget that thing about gold. This might be a real threat to this bull market?
Well, I'm the guy who had a forecast of gold at $10,000 an ounce, so I'm all for it. This is helpful, but I disagree with one thing you said, Ryan. Of course, all the facts are perfectly correct, but when you said we see it and everybody sees it, the first part's true. I don't think the second part is true. I think your everyday investor, and in fact, we don't have to talk about retail. Let's talk about institutions. Institutional allocations to gold are about 1-2% maybe.
But they are not allowed to invest in gold.
Many are not. That's correct. And a lot of 401ks cannot. And you're right about that. So yeah, there's a lot of money that is ring fenced away from gold or can't invest in gold. That's important. But some can, and they generally do not. They watch it. They hear everyone disparage it. They hear people talk about bubbles. They don't understand what's going on. What I tell people, and I have some some clients, I can't mention their names, but if I did, you'd go, oh yeah, those guys. I mean, they're some of the biggest funds in the world. And we talked about this. I say, look, you know, I have gold, you have gold. We all like to see gold go up in dollars or euros or whatever. I said, but it's not conceptually correct to think of gold's going up. What's happening is the dollar is going down. We're witnessing the collapse of confidence in the dollar. That's what's really going on. It expresses itself in terms of a higher dollar price per ounce of gold, yes, and the gold people are cheering, including myself, but that's not what's going on. The dollar's collapsing.
Yeah, may I add a few thoughts? So I think this discussion is a really important one. First of all, relative to what fiat currencies declining. So you guys had a little bit of an argument if the dollar is going to decline relative to euro or to other fiat currencies, but then we turned the corner, and I think that's a really most important question. Will it decline relative? Will fiat currencies generally decline or keep on declining relative to gold? I think the answer is pretty obvious to us. But also, I think the other viewpoint or the other mark, which one can reference point, which one can look at is, I think, commodities in general. And I think if one looks at commodity prices in general, there one can also perhaps gauge if the very important fact which Jim mentioned, if perhaps velocity at one point will turn. I mean, velocity, I think it's important perhaps to think about velocity as a backward-looking factor, because we can only calculate velocity looking backwards. So maybe true that velocity has no chance of turning in the medium term, but I wouldn't bet on it. And I think if one has one chance perhaps to gauge if to see if this picture is turning looking forward, then I think a very important component is looking at not only gold prices but commodity prices in general. And what we saw in the short term is commodity prices have been bottoming out recently. So it's perhaps too early to call for a huge change in dynamics, but some of the commodity prices, not only gold, Ronnie mentioned agriculture prices, energy prices have done quite a bit. They are rising. What we also saw is the gold-silver ratio. It peaked on March 22nd at 122. It came down significantly. That's also maybe a little bit more forward-looking indicator if perhaps this dynamic is changing. So I think there's quite a few other indicators, market-based indicators, which are worth looking at and trying to anticipate a change in velocity. And I'll make another point. What even though I'm probably would qualify myself as an Austrian-based thinker, Austrian School of Economics, I'm very aware of the fact that velocity is a big factor. And actually, it became aware to me when I studied Weimar Germany and looked at the very famous book When Money Dies, because what I learned there is that's basically the reverse case perhaps where we are now. Reichsbank stopped inflating or reduced their monetary inflation in the fall 23 significantly, and only basically inflated the money supply at the rate of 4x at the end of the hyperinflation. But the price inflation didn't stop. So they were inflating as crazy, and they reduced their inflation significantly, and price inflation kept on skyrocketing. And I mean, there is, I think, the reverse effect. The velocity kept increasing. So all the printed money which was out there had a higher and higher velocity. So it really didn't matter if that the monetary inflation was stopped, because then velocity kept on skyrocketing, and therefore price inflation kept on skyrocketing. And this is just worth mentioning because it can go both ways. That's actually the thing what I want to say. It's obviously not the case that we're anywhere close to a hyperinflation right now in the major currencies, at least. But once this money is out there, I think, and the other Austrians, I think, have some credentials in saying so, it's really difficult to get it back. And so the question is really how to gauge this psychological element. When will this behavior change? And my best shot at this is looking at some market factors, because the markets usually know more than we are, because it's a collective information in there. Yeah, so perhaps if you want to just add some thoughts on the recent commodity price dynamics, I think that's something what we are looking at very closely right now. Jesse, do you have some thoughts on that?
Sure. I think it's probably important to watch the oil price. Specifically, there's a lot of supply and demand dynamics going on there with the whole shale boom and everything. But I think it'll be interesting to watch what oil does going forward, and that will I think have a lot to say about what's really going on with the currency. Just from a perspective of being a trader, I look at gold. Fundamentally, to me, I turned bullish on gold in mid-2015, largely because I saw so much hate for it from a sentiment standpoint. The Wall Street Journal calls it a pet rock, and to me, that's one question I ask myself all the time: what's the most hated asset class on the planet? What's the most hated stock in the market? That's usually where there's some opportunity. And there was so much hate for gold in 2015 that I thought there's got to be terrific opportunity here. And the more that I looked at it, the more I thought, gold should do really, really well going forward. I do think gold's probably going to go to new highs. It could see $3,000 an ounce over the next couple of years. In the short run, however, though, I do think that we haven't gotten to that point like we did in 2011, where gold was on everybody's radar. I do think we're starting to see retail pile in. We're seeing a lot of interest in ETFs. But you look at past gold bull markets, and there's always 10-20% corrections over the course of a long run, and so I do think we're probably a little bit overbought in the short run in this trend. Technically, I like to see periods of gold. If you look at gold over the last year or so, you'll see really nice periods of consolidation and then strong breakouts. And that's not really what we've seen over the last couple of months. We've seen kind of incremental price highs with kind of waning upside momentum on a short-term time frame, which has me a little bit more concerned about a correction. And then also when we talk about potential for deflation, one of, I think, the strongest drivers for gold is real interest rates. And if inflation falls faster than interest rates over the next month or two, that probably leaves a potential for a corrective period. We also have a lot of speculators in futures markets, pretty crowded right now. So I'd love to see those folks shaken out in a correction just in the short run. But longer term, I'm still really, really bullish on gold.
We wrote in the gold report, it's based on a Dow theory. We entered this public participation phase, which is the longest phase, where media starts getting more positive, and Wall Street analysts and private bankers say you should have like 2-3% allocation. So that's like that's the fun part of the party, basically. But I agree that it's definitely not a contrarian investment. Now let me ask you, what's the most hated asset class now? Is it I don't know, is it agricultural commodities? Is it value? Is it Japanese equities? Is it silver? What do you think?
Well, small cap value is certainly very hated right now, but there's some very powerful trends in passive investing that are kind of conspiring to make that trade not work. I think for right now, I think one of the most important, investing or trading lessons that I've learned, over my career is when there's nothing to do nothing. And really what that means is wait for extraordinary opportunities to commit capital. You don't always have to be trading. And so for right now, for me, I have a balance of cash and gold because I want to have cash, I want to have dry powder to take advantage of opportunities in financial markets when I think prices are, valuations are more attractive. But I also don't want to have a bunch of money in cash when I think that the value of that cash is being rapidly degraded. And so I hedge that with a large gold position. And so I do think I don't see anything that jumps out to me today as a terrific opportunity, in the short term. But I do think we'll probably, my background is in the stock market. So especially in terms of the stock market, I think the only opportunity there might be in stocks right now is on the short side. I think we started a new bear market in March. And this rally is very similar to rallies we saw after the 1929 crash, after the March of 2000 kind of burst of the NASDAQ bubble. There was a nice rally going into the fall of that year. Even look back, I look at a lot of price analogs and look at the Japanese, the Nikkei implosion in 1990. And actually the S&P 500 looks really close to what the Nikkei did in early 1990 after its initial sell-off. So I think if there's any real opportunity, it's probably in the short side of the stock market right now.
Okay. If you should have 10 more minutes, we'd have two brief questions. And Jim, this is especially for you. It's about the upcoming US elections. And which was, of course, it will be quite an important driver for markets. And I saw that Predicted has now 60% chance of Joe Biden winning and 40% Trump. And it was interesting when I saw a comment which said that 2/3 of Biden supporters see their vote as being against President Trump. And this probably means that unlike the situation in 2016, they're probably more likely to show up and vote this time around. So what do you think about a sweep of the Democrats where actually it seems that the team of Joe Biden is filled with guys from the Bernie Sanders camp that are definitely very pro MMT and whatever they want to call it. Do you think this is really realistic with those odds that are pretty extreme now? And what do you think would be the outcome of a sweep of the Democrats in November?
So let's unpack. Well, my book, The Road to Ruin, came out in the fall of 2016, and I was on a worldwide. I thought it was a book tour, and I was doing network TV interviews in Australia and London and New York, etc. But the anchors, it was like a week before the election, and the anchors invariably said, "Well, Jim, you're the American here. Who's going to win the election?" And I said, and I did have a model I was following very close. I said, Trump's going to win. It's going to be close. We'll be up late. Usually their face would turn white. They would just be not know what to say. And then you get laughed at and all that stuff. But remember, that was at a time when the polls were giving, and the betting odds you mentioned were giving Hillary a 92 to 93% probability of winning. It was very apparent that Trump was going to win. And I'm using the same models today. They're updated. You continually update for improvement, whatever improvements you can make in terms of conditional probabilities and also data inputs. And I look at polls. You can pretty much throw away betting markets. They don't mean anything. And let me explain why. You mentioned, I think it says 60 or 70% chance of Biden winning. There was also 60 or 70% chance of the UK voting to remain in the EU. And I stood in a what they call a capsule or bubble in the London Eye on June 20th, 2016, 3 days before the vote. And I said that the UK was going to vote to leave the EU and that you should, buy gold and short sterling. And for months later, I got thank you notes. Thank you for helping put my kids through college, because that was the best trade of the year, which it was. So So using the same model, I'm just giving that background to make the point. Oh, sorry, let me finish the thought on betting odds. Here's why betting odds don't matter. If you're a bookie, you set the odds not based on the number of bettors, you set it on the weight of money. In other words, if I'm sorry, I got a little persistence there. You give short odds to the weight of money, not to the number of bettors. So what happens is that the Biden bettor will bet, $1,000, $2,000. They're the big shots. By the way, same was true in the city of London. It was all the bankers, city bankers betting 10,000 quid on Remain, etc. But the everyday guy, the guy in the pub, up in Lancaster, he was betting, 1 quid. And so you had one bet for Remain and one bet for Leave, but it was a 10,000 pound bet versus a £5 bet. And so you got to give the 10,000 guy really short odds. So you got to say, yeah, we're going to Remain. So what you want to know, I don't know if Predictive makes this information available or not, but don't look at the odds, because that reflects the weight of money. In a voting booth, money doesn't matter. You could be a billionaire or poor, but each guy gets one vote. So what you want to ask Predicted is just tell me how many bets each way, not the odds, because they're weighted by money. So that's why you can't throw away the unless you can get the raw data on the number of bets, not the odds or the weight of money, then it really doesn't mean very much. And the polls are all messed up. I've got a 50-50, and that sounds wimpy, but it's not wimpy because I use a Bayesian model along with complexity theory and a few other inputs. And what 50-50 really means is that there's a very high degree of uncertainty. We just don't know, and there's a lot of volatility around it. But one model I've developed, and you kind of referred to this, Ronnie, I don't think this is an election between Trump and Biden. I think this is an election between the good Trump and the bad Trump. Trump has this, he's had policy-wise just one huge success after another. Putting tariffs on China was long overdue. Trying to get jobs back in the U.S., long overdue. Cutting off Huawei, cutting off intellectual property theft from China. All the stuff Lighthizer did as U.S. Trade Representative, cutting taxes, every policy, almost every policy Trump has pursued has been extremely successful. But personally, he's vulgar, he's crass, he's a name caller, he's crude. And none of that mattered very much. If you don't like Trump, you don't like Trump. I mean, there's not much that can change that. And 73-year-old guys are not going to change their habits. You can bet money on that. But where Trump ran off the rails in late March, because I just wrote this book on the pandemic. It'll mention it's coming out soon. And one point I make is that the virus doesn't care. The virus is not a Republican. It's not a Democrat. It's not red. It's not blue. The virus just wants to kill you. That's all you need to know. The virus wants to kill you. That's all the virus knows. And the way we've politicized the pandemic is a disgrace, because it should be based on good science and good medicine, not, do I wear a mask? How did wearing a mask become a political virtue signal as opposed to, good public health? We don't know. Well, we do know. That's the unfortunate part of it. So Trump started out okay. I think, putting the travel ban on the Chinese in January, really good move, saved tens or hundreds of thousands of lives. He then extended that through a series of proclamations. Andrew Cuomo's on TV every day. Ventilators, 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 get me ventilators. And Trump actually got the ventilators. He used the Defense Production Act. By the way, the ventilators turned out to be an enormous blunder. They killed a lot of people. They don't work. You need pure oxygen. You need other treatments, but not. Ventilators are almost the worst treatment you can think of. The doctors didn't really understand the disease, et cetera, et cetera. The ventilators were never used. New York City never ran out of ICU beds. Trump delivered everything that the governors want. Trump made one huge mistake, which is typical of Trump. He stepped out in front of this. We never had a national lockdown. There's no such thing. You could have it. The president has the power. We had 50 individual state lockdowns, ranging from extreme measures in Michigan, Maine, New York to some extent, and other states, to South Dakota, which had no lockdown. South Dakota governor never gave an order to do anything. He said, yeah, wash your hands, wear a mask if you feel like it, stay home if you're sick. But the governor never made anything mandatory in South Dakota, and then other states went to extremes. So what we had were 50 governors and a whole bunch of mayors and city councils making individual decisions, which is probably the right way to do it because conditions vary from coast to coast. But Trump made the mistake of making himself the center of a three-ring circus. So he caught the blame for all the failures when they weren't necessarily his failures. Trump has made it very easy for everyone in America to duck responsibilities, like, oh, burning down the cities, blame Trump. You know, virus is out of control in Texas, blame Trump, you know, et cetera. So, and then he started picking fights with John Carl. I mean, John Carl's a nice guy, I know him, but, you know, he's not a policymaker. He's not chairman of the Fed. Why is Trump? And so Trump just did everything wrong from a perception point of view, even though his policies are pretty good, dug a hole for himself. So this is Trump versus Trump. Can Trump, I mean, Biden, the thing about Biden is pretty far along in dementia. He's suffering, whether it's early stage Alzheimer's, early stage dementia, it's a progressive disease. It jumps in exponential leaps. He can't finish a sentence. He can't compose a coherent thought. He'll be medicated if he does have to go on stage in the debates. We're electing and I don't say this with any, I say this with nothing but sadness, and I wish his family would intervene, but we're in the process of electing a serious mental health defective cognitive deficiency as president of the United States with nuclear warfighting powers. So how cynical do you have to be to push that guy? Now, what they're going to do, you need to watch the vice presidential selection, because the vice presidential selection for Biden will, in effect, be the next president of the United States if the Democrats win. And they know it. And that's why they're fighting over it. We've never seen fights like this for the VP job. So if Biden wins, the cabinet will be a bunch of Obama, you know, recycled resistance people. You'll see Sally Yates, the Secretary of, as Attorney General. You'll see Susan Rice, if she's not VP, she'll be Secretary of State, and so on. So Biden, who is mentally incompetent at this stage, will be surrounded by Obama resistance figures, and they'll exercise the 25th Amendment, remove him from office, you know, sometime in mid-2022, or 2021 rather, and then the VP will become the president. So if you see, think of President Susan Rice or President, I don't know who else is in the running, Val Demings. There are a number of names out there. That's how you have to think about it. Now, here's my question for you, Ronnie. How much of what I just said has the market discounted? Zero. I promise you. The market is all it can do to discount the on again, off again impact of the pandemic, discount the effect of monetary policy and the economic depression. It's all the market can do to discount those two really big stories. They haven't really begun to think about the election. It's 3 months away. So we're in for another shock from that source alone.
Thank you very much. Jesse?
Yeah, I don't have any models to predict who's going to win, but I do think there is a good chance Democrats take the White House and the Senate, and I agree that you know, Biden has been telling donors, I'm going to undo the tax cuts. I'm going to undo the corporate tax cuts. If you look at just S&P 500 earnings since 2016, I would argue, and I haven't looked at the data, but you look at S&P 500 earnings versus just corporate profits as reported by, you know, as you can find on Fred, and there's a huge disparity. And a lot of that is, you know, some of that is buyback, some of that is accounting, but I think all of the growth, a majority of the growth in earnings in the last few years is just the corporate tax cuts. And so if you undo those corporate tax cuts, you're talking about a big drop in earnings. That we're already seeing a big drop in earnings. I think we're looking at what, 40% drop in earnings. I think is what FactSet is saying for Q2. And if you add, you know, essentially a corporate tax raise, you know, next year, you know, going into the year after, that's going to be very, very bearish for the stock market. Stocks are, you know, part of this is, you know, people look at price to earnings ratios. The price to earnings ratios are very high. But price to earnings ratios don't account for the fact that corporate profit margins were very recently at record highs. Profit margins, if you mean revert profit margins to historical average, you're looking at the highest valuations we've ever seen in stock market history. So as you know, part of that mean reversion is probably rising corporate taxes. So I think that's what a lot of people go, wow, PD ratios are high. But if you look at a PD ratio adjusted for normalized profit margins, we're totally off the charts. And so there's potential for a huge reckoning in the stock market. And maybe that catalyst would be, undoing those corporate tax cuts.
Very good point, Jesse. We're coming to an end, but we got a question from a young follower who's really a very nice bloke, and I think that's an important thing, because he asks, do you have any advice for young people wanting to enter the investment management industry? Where will the best opportunities be in the next 10 to 20 years, or is the financial service industry so saturated that young people should avoid the industry altogether? What would your recommendation be for a young folk?
Well, I always just basically repeat the advice Warren Buffett has given, because I wish I had taken it when I was entering the industry. It's just find somebody that you really admire and try and go work for that person. I think it's important to find somebody who you admire, not just from a professional standpoint, but from a personal standpoint. You think they're not just good at what they do, they're good as a person, and you really can't go wrong. You're going to learn a ton, even offer to work for free if that's what it requires. But I think that's probably the best way to get your start in any business, really.
Yeah, I agree with Jesse. I think it's excellent advice. Someone measured by Myron Scholes, I worked with for many years. He said when young people are looking at colleges to go to, they tend to go with the brand. I want to go to Harvard or Stanford or Yale or Columbia. He said that's nonsense. He said figure out what you want to do, and some people can't. That's okay. But if you can, figure out what you want to do and find the best school for that specialty, which is exactly what Jesse was saying, because you'll get the best mentoring. If you want to be a writer, don't go to Harvard. That's a nightmare. Go to the University of Iowa. The University of Iowa has the best writing seminars, creative writing program probably in the world, certainly in the United States. And so you go to Iowa if you want to be a writer. Don't go to Harvard. And as far as going into the wealth management industry, it's a growth industry. It's the field is still expanding. A lot of things are contracting all around us. But as the baby boom get older, as people retire, and all of a sudden you don't care about big returns, you just care about preserving wealth. The money management business is going to be more important than ever. So I think it's a growing field. If you want to be successful at it, I think Jesse gave some good advice. I would add, don't study economics. You'll be miseducated. You'll learn a lot of things wrong. You're better off studying physics and psychology. If you do physics and psychology and applied mathematics, you'll be a much better wealth manager than if you study economics, most of which comes under the heading of miseducation.
Excellent advice. Thank you very much. Jim, by the way, there's a cat behind you. I hope she doesn't.
Right. Yeah, it's not a white Persian. I'm not Blofeld, but yeah, it's my daughter's cat. We're cat sitting.
Great. All right, gentlemen. It's been a great pleasure. Great discussion. Thank you very much, Jim. Thank you very much, Jesse, for joining us. We really enjoyed it. We will publish the transcript and we will publish the video. We will send you the transcript, of course, in advance. And yeah, now we wish you a fantastic summer. Be good, be safe, and be healthy. Thank you very much for taking the time.
Thanks.
Thank you, gentlemen.
Yes, gentlemen. Thanks.
Bye-bye.
Thank you. Take care. Bye-bye. Thanks.